All right, here I am with my friend Nancy. She never shows her video image. All we hear is a voice. So I think she might be a robot. I think it is. We're in an artificial intelligent world with AI, and maybe she's a bot of some sort. Just sit. But Nancy had asked
Yes.
me about the wheel strategy, right?
Yes.
Where have you heard about the wheel strategy?
I saw someone had mentioned on Facebook on the
Okay.
Tasty Trade.
Okay. So you've seen it on Tasty Trade and you wanted to hear more about it and you thought that I could help you.
They just mentioned on Facebook. I didn't look at Tasty Trade.
Okay.
Tasty Trade, the group.
Yep.
Okay, that one.
All right. Well, here I'm going to explain this wheel strategy. So this it might be a review for you because we covered this when we did the boot camp.
Yes.
So really what you're doing is you start off by selecting a stock that you're bullish on. And I would suggest that it also be a stock that has a high liquidity. And what high liquidity means is there's enough trading in the options that there's a very small spread between the bid and ask. You know, stocks like Microsoft, Apple, they have good liquidity. If you can't, you need to also pick something that you could afford to own at least 100 shares if it got assigned to you. A good stock for smaller accounts might be Ford that trades under the symbol F. So you select a bullish stock. The second thing you do is you sell puts against it. Now, on your text, you would ask me what delta put, and my favorite is in between 20 to 30 delta. So what is delta? It's kind of how far away it is from the money. 50 delta is always at the money. So you get smaller than 50, you get further away from the money. The further away you get from the money, the less credit you get. The closer you get to the money, the more credit you get, but the higher the risk of assignment. If you're selling a 25 delta, there's approximately a 25% chance that you'll get assigned. Personally, I like to sell puts about 30 to 45 days out into the future, and I prefer to sell the monthlies rather than the weeklies. Okay, follow me so far?
Yes. Yes.
All right, so let's say you sell puts for 3 months, you know, and you collect $1 every time you sell these puts. So you've now collected $3. And let's assume the stock is selling for $50. And now all of a sudden on month 4, you get assigned the stock at $50. Now your cost basis is $50 minus the $1 a month you sold on your puts for 3 months. So now your cost basis for the stock is $47. Follow me so far?
Yes.
So now you own the stock at $50. If it's 100, if you have 100 shares, that's $5,000 is now locked up in owning the stock. So now let's say you sell an out of the money call and you collect $1 on the out of the money call. Let's say you do that now for 3 months, selling the 25 delta until you get assigned. So now $57 minus the $3 you collected on the calls. Now what's your cost basis is 54. No, it's 50 minus 3 is 47. 47 minus 3 more is 44 is now your cost basis. You follow me so far?
Yes.
So now you would lose the stock and now you would start over. The same one or a different one. So that's why it's called the wheel strategy.
Okay. So you do only one side, right? You only sell the put.
You're only selling the puts.
And you sell the call only if you're assigned.
You only sell the call if you're assigned. Yes.
Okay.
Now I did this for about 5 years on Apple, and then I computed my cost basis, and it was minus $40 a share.
So it was
Because
a lot.
I had collected enough premium from selling puts and selling calls that my cost basis on Apple was minus $40. So what that means, it's like somebody paid me $40 to take a share of Apple.
So that's a good thing, right?
That's a great thing. It's almost like if you owned a house and you bought the house for $100,000 and you rented it out for long enough that the cost basis on the house was minus $40,000. So if now you sold it for
Yes.
you follow me. Okay.
Yes.
So that is basically the wheel strategy. Now, what questions do you have?
Now, when you find a stock, don't you find something that doesn't go up when you sell the put?
It's really not your objective for the wheel strategy. The wheel strategy is you really like the stock and you're moving in and out of it, but you really don't mind owning it. You probably don't want to do it on a stock, the wheel strategy on a stock that you wouldn't like to own.
Okay. So say a Delta 30 for Microsoft would be what, say, so you sell a put at 30? Okay, well, let
me bring up TOS now, and we'll work through a real example. So let's say we're looking at Microsoft. Now, one of the things in order to effectively do the wheel strategy is you need to have enough money in your account so that you could at least buy 100 shares of Microsoft. So 100 times 293 is $29,300. So unless you have, or you could get access to that capital, you probably don't want to trade it in Microsoft.
Okay.
You follow me?
Yes.
Would you be able to do that in Microsoft, or do we need to pick something that's a smaller?
Something smaller.
All right, well, let's pick something that's small, like Ford.
Okay.
Okay, so, it's a smaller one, but if we look at Ford and we sell a $13 put.
I don't see the screen.
I don't see my screen. Sorry about that.
That's okay.
Let's see. Let me share my screen again. And this, you'll see it now, I believe.
Yes.
So Ford is currently trading at $14.12. So if I sold the $13 put, which is currently a 26 delta. Okay, so let's sell the $13 put. So, what you would need in order to buy 100 shares of Ford is at least $1,400. So how much capital would you like to put into this strategy for simulation purposes?
So you have to buy 10?
No, you don't have to buy 10. You have to buy you have to sell at least one. And that would be, you need to have access, or you could get access to $1,400. Now, what I mean by that is you could have it tied up in other things, but if you get assigned, you're going to have $1,400 for every 100 shares you do it in on Ford. Okay. You follow me?
Yes.
Okay.
So how much do you get credit? Only 33 cents?
On 13 cents for 100 shares, you'll collect $32.
Okay. So normally when you do this, you do like 5 or?
Yeah, I mean, I would do 10 if I was doing it, on my account, and it would that would bring in $326, and it would only take $1,000 in buying power. But I would need to have access to 13, 1,000 times 14, I'd need to have access to $14,000 if I got assigned.
Mm-hmm.
Or you close out the option, but you don't have a complete wheel strategy. If you're closing out the option, you're just selling naked puts, which is like half of the wheel strategy.
So in this case, it shouldn't go above 13, or it should go above 13?
Well, you have a 75% chance that it won't go down to 13.
13, okay.
But if it goes down to 13, you're going to get assigned.
Okay.
So, you know, if you like Ford at $14.12, wouldn't you like it better at $13.79?
Yes.
Yeah. So that's what you'll end up getting it for if you sell the $13 put and you get assigned. Essentially, you're getting Ford for $13.79. Now, if you do it for 3 months, you're going to get it for roughly $13.
Okay. And then if you get, yes. And then if you assign it, you go 30 delta would be what on the other side, the call, you'll get only what?
Well, if you got assigned at 13, we don't know what the calls are going to be selling for, but right now, the $15 calls are trading between 41 and 42. So if you did it on 10 contracts, you're getting $410. And selling the puts, you're getting $330 if you're doing it for 10 contracts.
Okay. So when you're selling the call, I mean, it's for sure it'll hit 15. It shouldn't go below 15, right?
Oh, well, you're kind of trying to predict what the market is going to do and what you want it to do. With the wheel strategy, you really don't care. You want the stock. You like the stock. You're bullish on the stock. So you'd kind of like to have it. But you'd kind of like to get it on sale. It's kind of like you go shopping, you see a jacket, you say, I really like that jacket. In fact, I'm really tempted to buy it, but I could sell a put on it below where it's currently trading at. I'm not in a hurry to get the jacket. And then when it ends up going down to that price, then I'll own it at a discount. That's essentially what you're doing with the wheel strategy.
So normally when you sell calls, and say in this case, we just sell the call at 15, you don't sell it that close, right? When the stock is at 14?
You could, or you could go out to 16.
16, okay.
But you just got to realize if you've owned the stock and you're like, man, I don't really want to own the stock because I kind of like selling premium. And now I've got $14,000 locked up in Ford and I'd like to do other things with it. Well, then sell it closer, sell the 35 delta. And now you've got a 63% chance it's going to get hit. So it gets hit, it gets taken away from you at 15. You say, thank you very much for the $15,000. And now I no longer have Ford. And now I turn around and sell puts at 14 for the next month.
Okay.
So it's just, you're always lather, rinse, repeat, always sell premium, always be selling premium against everything that you own. Okay. At least that's my philosophy. Does that help?
Yes, that helps.
Okay.
Thank you so much.
Any other questions?
No, I just saw that and just thought I'll ask you.
Yeah, well, happy trading. And the good thing about Ford is it's a small enough underlying. Not that I'm advocating Ford, but you know, it gives a good option in a smaller account because you can, it's not very pricey.
Yeah. Okay.
All right, happy trading.
Thank you.
All right, thank you. Bye.